Once you understand what drives gold prices, the next question becomes how to gain exposure. But not all gold investments are created equal, and many investors confuse price exposure with risk profile. Let's break this down carefully. First, physical gold, bullion, and coins. This is the most traditional form of gold ownership. This includes gold bars, bullion coins, and minted gold products. The appeal is simple. Physical gold has no counterparty risk. There is no issuer, no balance sheet, and no promise to pay. If you hold physical gold, you own it outright. This is why physical gold appeals to long-term wealth preservers and investors worried about systemic risk. However, physical gold comes with real-world frictions. Key drawbacks include storage costs, insurance, and security risks. It is also a liquid compared to financial assets. Physical gold is not ideal for trading. It is slow and expensive to move. In practice, physical gold functions more like financial insurance than an investment. If you're buying physical gold, you are prioritizing ownership certainty over returns. For most investors, gold exposure comes through ETFs and exchange-traded products. These instruments are designed to track the spot price of gold. They offer high liquidity, tight bid-ask spreads, and easy portfolio integration, allowing investors to allocate quickly and rebalance easily. But it's important to understand what you actually own. With gold ETFs, you own a financial claim, not physical gold. You are exposed to custodial and structural risk. Redemptions are usually not possible. This doesn't make ETFs bad, but they serve a different purpose. They are best suited for tactical allocation and macro positioning, not as substitutes for physical gold in a systemic crisis. Next, gold mining stocks. This is one of the most misunderstood areas of gold investing. Gold miners are equities, not gold. They are businesses that extract gold, operate under political jurisdictions, and face labor, energy, and capital costs. Common issues with gold miners include cost inflation, poor acquisitions, dilution through share issuance, and political risk. Even in strong gold bull markets, mining stocks have historically underperformed expectations and lagged spot gold returns. Miners offer operational leverage, but that leverage cuts both ways. You are not buying gold. You are betting on management executing well in a difficult industry. Part 6. Leveraged gold trading, where most losses happen. This is where gold stops being a macro asset and becomes a trading instrument. Leveraged gold exposure includes futures, CFDs, options, and margin-based spot trading. Leverage amplifies everything: gains, losses, and emotions. Gold is often perceived as stable, but that's misleading. Gold can move 1 to 2% in a single session or spike on economic data. With 10 times leverage, a 1% move becomes 10%. With 20 times, a routine gold fluctuation can wipe out an account. Key risks include margin calls during volatility, forced liquidation at the worst time, and sudden reversals when consensus is crowded. Gold behaves counterintuitively in the short term. Trading is driven more by positioning, liquidity, and interest rate expectations than by long-term fundamentals. Part 7. What investors should actually watch. Instead of headlines, serious gold investors focus on signals. Key indicators to monitor. 1. Real interest rates. This remains the most important driver. When real yields fall or turn negative, gold becomes more attractive. 2. Currency trends. Gold tends to benefit when confidence in fiat currencies weakens, particularly the US dollar. 3. Central bank policy. Rate caps, balance sheet expansion, and financial repression support gold long-term. 4. Positioning and sentiment. When gold becomes overcrowded, pullbacks are common, even in bull trends. Gold rewards patience and discipline. Part 8. How gold fits into a portfolio. Gold works best when it is a complement, not a centerpiece, sized conservatively, and held with a clear purpose. Gold is not meant to maximize returns or replace productive assets. It acts as a hedge against monetary risk and a diversifier during policy uncertainty. It is a store of value when real returns are suppressed. Owning gold without understanding why leads to disappointment. Closing. The truth about gold. Gold is not magic. It is not obsolete. And it is not a guaranteed hedge. Gold reflects confidence, or the lack of it, in monetary systems. It performs best during slow debasement, persistent deficits, and financial repression. Gold doesn't need collapse, it needs mismanagement. The key isn't owning gold. The key is knowing why you own it.